and regular practice is the only way, okay, to handle this chapter. Now let us understand word by word what is portfolio. Portfolio means, if you ask someone na, what is portfolio, they will say bunch of stock. But now recently the finance is so dynamic, but the financial markets has got so dynamic now. Recently REITs was means it was introduced long back, but now the trading means people can invest in REITs also. REITs is nothing but, means what I mean to say is, I don't expect you to know these words, okay, obviously, but there are so many venues got opened for the investors that the portfolio can be diversified into like anything. You can have n number of things in your portfolio, okay. So what is REITs? Real estate investment trust. It is similar to mutual fund. Let's say you don't have the knowledge of the stock market, so what you do, someone tell you that this mutual fund is good, so invest in that. Similarly, if you want to invest in real estate, see that buying a whole unit, it involves huge money now. So what you do, there is company who invest in real estates and you can buy the units from them. Ultimately you get benefit of what? At lower investment you get benefit of what? Benefit of real estate, correct now, the returns. So that is real estate investment trust, or REOCs is there, then real estate operating. Then recently this now I think last 3 to 4 months back only, they have allowed REITs to issue the company the REITs, especially in commercial properties only. Means only the commercial properties REITs can be issued. Means that company, REIT company, can buy only the commercial properties, not residential, okay, and you can buy the units. Approximately, I don't know to today's price, but approximately the unit price is 28,000. Then just for the sake of knowledge, one more thing has come recently. It is InvITs. I don't know the spelling. InvITs it is called. InvITs is infrastructure. Okay, means if government is building something, that company builds the infrastructure and they sell you the units. Ultimately you get the benefit of the infrastructure also, because directly though you don't have that much money now that you will build highway for the country, correct. So many things. So this all things, traditional investments is what? Equity, bond and all those things. Plus you can have derivative instruments in your portfolio. Plus you can have these investments like alternative. What are the alternative? Like portfolio means what? Portfolio means holding of the securities, okay. Portfolio means what? Holding of the securities belonging to any person. Whatever I hold, okay, is what? Portfolio for me. Portfolio management now is concerned with efficient management. Means whenever, what is portfolio management? Portfolio we understood. What is portfolio management? Means managing that portfolio efficiently, so that what you should do, return should be maximized or minimized. Maximized. Risk should be what? Maximized or minimized. Efficient portfolio means minimum risk, maximum return. That is efficient portfolio. As simple as that. Understood? Okay. So we try to do this. How? By minimizing the risk, by increasing the return. We try to bring an efficient portfolio. Means we try to invest in that efficient portfolio. Okay. Now every person's now portfolio preferences can be different. Like my risk taking capability is different. Your risk taking capability is different. Okay. Your return preference might be different. Understood? So everyone's now risk and return preferences are different. Is that clear? Because everyone don't have a good knowledge of the markets, right? Therefore they hire whom? Portfolio manager. Okay, you give him your fund to him and he manages, because he has a right knowledge. Like a person like me can be employed as a portfolio manager, so who has a right knowledge about the market. I'm just giving an example. Means everyone, after studying in CA final also, you can also, if you're specialized, if you know the different avenues how you can generate a returns for your clients, then obviously you can become a portfolio manager. Okay. So recently what happens is, means the portfolio manager now, their role has increased. You should have a good knowledge, you should have a good expertise, okay. And why it is very useful to have a portfolio manager? Because this market is very volatile. I know the person who means, see, I will tell you, in markets, I'll tell you to be frank, who makes profit? Only 10% of the investors make profit. Now these 10% are well informed, means they have the edge to make the profit. They have the correct knowledge about the market. And 90% na, they don't know anything about the market, still they invest. Chalna karke dekhte hai. He did, so I will also do. Understood? Last week I met one person who lost 3.6 lakhs in one day. Why? Because he didn't have the knowledge of future and options. Still he bought call option, put option and all. Okay. So I think people are laughing, means here also we have such characters. Okay. Okay. So there are many people, okay, who lose money like this because the market is volatile now. Okay. So that is the thing. So what is this function of the portfolio managers? They have to study the economic environment continuously. They have to continuously update themselves. What is the government policy? Okay. How is the inflation? How is the taxation policy? What the government is going to come up? Whether the government is again going to come up with what? Demonetization. Understood? So all these things you should have a good knowledge. Okay. They need to study what? Securities market. Fine. They should understand that this COVID is running, so which industry will have the more problem? Correct? Right? Or other situations, like anytime if there is a problem, some industries they might have a problem now. Correct now? So if you offer your investors, your clients, the securities from that industry which is not going to perform well, what will happen? You will wipe out his capital. Correct? Right? Then you should understand the behavior of these financial institutions, banks and all. Okay. So all these things is very important. Why we need to learn? What is the objective behind learning this portfolio management? Why we need to learn portfolio management? Okay. Obviously, see, as a teacher, I think at least at the CA final level, I can't teach you how to by heart the points. It should come out of you, no? Means we can't by heart all such things, right? So whatever I have discussed, it can come in the theory. Fine, whatever I am discussing, and it is given in the notes. What is the objective? Objective of portfolio management is nothing but, see, understand, whatever the principle you are putting now, correct? In that, at least you should not erode your capital. Means you have invested 10 crore. What is the main target of the portfolio management? If you don't earn the return, then it's okay. But at least don't erode this. Don't wipe this out. Correct? At least your purchasing power, means at least how much you should earn. Always I say that person should earn minimum whatever is the inflation rate. That much he minimum he should earn in the period, in a year. Why? See, simple example I will tell you. If you have 100 rupees, right? I don't know whether I discussed this in the previous class or not. But if you have 100 rupees, right? And let's say either you can invest it for 1 year, okay? And FD fixed deposit is giving you 5%. So at the end of the first year, this is 0th year, this is first year, you will have 105 rupees. But if the inflation is 10%, then obviously what you can buy today at 100 you will get it at what? 110. Understood now? So minimum. So are you understand what I'm saying? So whatever you could buy at a cheaper rate, it got expensive now, right? And you're not earning that much. So that means what? You should not do a FD. You should instantly buy the thing so that it becomes cheaper. Here, instead of putting, means extra 5 rupees you will have to put from your pocket. Understood? So why? What is the objective? That your security, your principal should be secured and your purchasing power remains what? Intact. Sometimes some people's objective is what? Stable income. Like some people are there who are aged, okay, retired people. They want what? Stable income. So obviously where they will invest? Bond market. Correct? They will do FD, they will do bond market. Right now, in FD, now so I don't think there is left something. It just gives you 6-7%. Okay. Obviously, what is your objective of the portfolio? Why you want to have a portfolio management? You want to grow your capital. Correct? Right? Your security should be marketable. Marketable means what? Marketability and liquidity. Marketability and liquidity. This should be the feature of your security. Right now, this should be the feature. Securities can be easily purchased and sold without much loss. That is called marketability. Okay. And if means if there is suddenly the prices go up, instantly he should be able to sell that. Okay. He should be able to exploit that market. Yes, exploit. He should be able to convert that into the cash. That is called liquidity. Understood? Diversification. This is the most important point. What is diversification? The investment should be diversified. Like we always say, don't put all your eggs in one basket, right? That is a famous one. Correct? So it should be diversified so that what? Your the risk of loss gets reduced. Correct? Many times, what is the objective? The people's objective is tax advantage. Why they want to take the tax advantage? Like they invest in such securities that they want, means they might be in the higher tax bracket, no? So they want to make an investment where their taxes get reduced. Okay, you might be having better knowledge. ELSS, equity link saving scheme, correct now? NSE, fixed deposit, right? PPF, right? And tell something about the tax now. Some you people might be having more knowledge that 5 GEC, 5G EC, what it is? Remember? 5G EC or something is there now. I don't remember. I don't know actually. Yeah, bond, right, bond. Right. Highway bonds and all, infrastructure, all those. National highway bonds. So, yes. So you get tax advantage. Correct now? Is this clear? What are the sources of risk? Okay. This was there in the bond chapter also. I didn't explain because I wanted to explain it here. Okay. There is something called as first one, interest rate risk. Now what is interest rate risk? It is the variability in the securities return resulting from the change in the level of the interest. If the interest rate changes, you remember bond, when the interest rate goes up, bond value what? Falls. Correct now? Right? Security prices now, they are inversely related to the interest rate. Correct? And who is affected by this interest rate? The bondholders are more affected than the equity investors. Understood what I am saying? Next, inflation risk. If inflation is high, therefore now government is always behind this. They want to control what? They want to control inflation. Correct? They want to control inflation. What is inflation? Why there is inflation? Why inflation is not good? Because it reduces your purchasing power. Right? It will affect all the securities. And obviously it is directly related to this interest rate risk. As the interest rate goes up now, inflation also goes up. As the interest rate goes up with inflation, okay, it is directly related. Inflation will also go up. Next is business risk. Business will be change in the government policy. There can be change in the government policy, no? Okay. Because of that, which your business has got affected. Right? Correct. Financial risk. A company using more of the debt will have what? More financial risk. Understood? When companies resort to financial leverage or use of the debt financing, right now, they have the more financial risk. They are more levered. The last two are what we discussed. One is liquidity risk and another one is market risk. What is liquidity risk and what is market risk? Liquidity risk means you want to sell the security. Okay, understood? But you are not able to at the time when you want to. Understood? There is a thin line between liquidity and marketability. Please understand this. Liquidity means you are ready to sell, but there is no buyer. Okay, means the volume is less. Understood? But it will get sold off in near future. If you ask me what is market risk, then sir, You are ready to sell at whatever price you get, but no one is ready to buy. There is no market only. Understood?